Today we're diving into 5 Dividend Aristocrat stocks that yield as much as 6% and are trading near 52-week lows. It's a good time to look at these income ideas because we are living in a momentum market right now that's dominated by growth and AI stocks. Dividend Aristocrats kind of feel like the tortoise in Aesop's fable. You can see that the group has significantly trailed the S&P 500 over the last 2 years, but aristocrats have historically kept pace with the market over the long run with lower volatility as well. I don't think today's trends will last forever. Aristocrats are some of America's most durable businesses with track records of raising their dividends annually for at least 25 straight years. The high-yield aristocrats I'm spotlighting also each earn a safe or very safe dividend safety score from us, and they seem likely to become larger businesses over time. However, they look historically cheap today compared to the broader market. The first stock we'll look at is PepsiCo, ticker symbol PEP. PepsiCo is one of the world's largest food and beverage companies with iconic brands like its namesake Pepsi, Gatorade, Lay's, Doritos, and Quaker Oats. The business is very global with around 40% of sales coming from outside the United States, including roughly 20% from developing markets like Latin America and parts of Asia. Right now, shares offer a 3.7% dividend yield, which is about their highest yield in at least 30 years. The stock also trades at a forward P ratio near 17, which is far below Pepsi's 5-year average multiple of 24. Usually these steep discounts reflect a company facing a rather dark future, but analysts still expect Pepsi to generate about 6% to 8% annual earnings growth in both 2025 and 2026. The company also earns an A+ credit rating from S&P, plus a very safe dividend safety score from us. Pepsi announced a 7% dividend hike last February as well, which continued its streak of rising payouts every year since 1971. I think the company will push through at least a 5% raise next month if management desires to do so, but prioritizing share buybacks at these levels could make more sense than pushing the dividend faster. So what's the catch with Pepsi? Why does this dividend aristocrat look so cheap? Some investors are worried about the impact of GLP-1 weight loss drugs since people taking these medications might buy less junk food in the future. It's still early days here. I saw that Darden, which owns Olive Garden and Longhorn Steakhouse restaurant chains, said that about 6% of the U.S. population is currently on those drugs. Could that figure double or even triple over the next 5 to 10 years? Maybe. The impact would become a lot clearer then on consumption trends. The good news is that mass adoption of these medications won't happen overnight. Food companies have some time to keep evolving their portfolios, and Pepsi has long been working to reduce sodium, fat, sugar, portion sizes across its product lineup. I think it's also fair to say that consumers on weight loss drugs might consume less of some categories, but more of others. A business like Pepsi touches many areas across both snacks and beverages, giving it some more flexibility to adapt. It's also a positive that Pepsi has a large footprint in overseas markets that should benefit from a growing middle class and likely see less uptake of pricey GLP-1 drugs for now. So for now, I'm comfortable betting that Pepsi can adapt to changing customer preferences, and also that weight loss drugs are probably more of a headline risk than anything else, but we'll see. This could take several years to really get our arms around. I think the bigger near-term concern is tapped out consumers after years of aggressive price hikes taken across big food. Inflation drives consumers to hunt for deals, making for a more promotional environment and greater competition from private label goods. Pepsi is still tracking to generate pretty healthy profit growth in this environment, but it could take several years for consumers' wallets to catch up to today's food and beverage prices. That would keep kind of a lid on volume growth in the near term. That doesn't bother me too much as a long-term investor, assuming that Pepsi's brands can continue to maintain their really strong market share positions. So I plan to keep holding my shares, which I have owned since 2015. Next, we will head to the real estate sector to look at Realty Income, ticker symbol O. Realty Income owns thousands of retail properties across America, but also has a portfolio of industrial facilities and some gaming properties as well. These buildings generate predictable rental income from long-term leases with a highly diversified group of tenants, including everything from dollar and drug stores to grocers, convenience stores, and casinos. Shares of Realty Income have a dividend yield that's near 6%. That's about as high as the yield has touched during the depths of the pandemic, where many of Realty Income's tenants were forced to temporarily close their businesses. While COVID is obviously no longer a concern today, interest rates have weighed on Realty Income's share price this time around. The REIT's dividend yield has historically been strongly correlated with, or moved in the same direction with, the 10-year Treasury yield. This makes some sense since Realty Income is what I would consider to be a bond-like stock, or basically a low volatility stock with very slow growth rates. The 10-year Treasury yield has jumped over 1% since September, which has put upward pressure on Realty Income's dividend yield as well. The stock's near-term movement will probably be driven by the direction of interest rates, but Realty's fundamentals remain rock solid. The REIT's cash flow per share is continuing to grow, albeit at a kind of a low single-digit pace, and its payout ratio, or the percentage of its cash flow that is consumed by dividends, hasn't been this low in at least a decade, which provides a really nice margin of safety. Realty also continues to maintain an A- credit rating, which is among the strongest across all REITs, and it's held occupancy near 100% across its property portfolio, showing the in-demand locations it owns. Coupled with a monthly dividend that's backed by a safe dividend safety score from us, Realty Income is a high-yield aristocrat that should appeal to conservative income investors who are comfortable with the stock's sensitivity to rates. Johnson & Johnson, ticker symbol J&J, is our next cheap aristocrat to highlight. J&J is a healthcare giant that derives a little over half its revenue from a diversified portfolio of patented medicines, while the rest of the business consists of medical devices and technologies across areas like orthopedics, cardiovascular care, surgery, and vision. Shares offer about a 3.4% dividend yield and look cheaper than they were during the pandemic, as pharma stocks have faced pressure from regulatory fears and election year worries about drug pricing reforms. One issue is the nomination of vaccine skeptic Robert F. Kennedy Jr. as Secretary of Health and Human Services, which has weighed on investor sentiment, but sweeping changes in healthcare have historically been quite difficult to achieve, so this feels like more of a headline risk to me. Some investors have also remained worried about J&J's talc-related lawsuits tied to its baby powder, but these seem unlikely to impact the company's long-term outlook or its financial health and dividend policy. Most estimates I've seen peg this liability at no more than about $15 billion and paid out over the course of many years. While that sounds like a lot, it's actually a pretty manageable situation for a business that's on track to retain about $10 billion of cash flow each year after paying dividends. J&J also boasts a AAA credit rating and has a healthy payout ratio near 50%, which should support mid-single-digit dividend growth over the long run. Patent cliffs aren't a major concern either, since the company isn't overly exposed to any single drug or treatment area, and it has a solid pipeline that seeks to deliver 10 or more assets with at least $5 billion of peak annual revenue potential by 2030, which is a pretty impressive goal for a segment that generates more than $50 billion of revenue. Overall, I view J&J as one of the highest quality defensive stocks in the market, and it's trading at one of its cheapest valuation levels in years. Up next is Genuine Parts, a nearly 100-year-old distributor of automotive and industrial replacement parts that primarily serves customers like mechanics, automakers, food processors, and mining companies, mostly in North America but also in Europe. Unlike the first three companies we looked at, Genuine Parts' high dividend yield of about 3.4% reflects some fundamental weakness. Shares had their worst single-day drop in October with a 20% plunge. Management called out several macro factors, including weakness in Europe and industrial markets, as high interest rates drove spending cuts and project delays. In North America, discretionary auto repairs have also softened as inflation-weary consumers postponed non-essential fixes. Now, I don't know when some of those issues will fade away, and they could always get worse in the near term. But I believe that Genuine Parts maintains strong share in very large and fragmented markets that sell essential parts, have a slow pace of change, and prioritize fast delivery times, inventory availability, and knowledgeable service over price. Genuine Parts has also continued investing in automating its distribution centers, modernizing its store systems, and expanding its inventory to further improve its service for customers and differentiate it from smaller rivals, which should help solidify its role as a market leader and consolidator. We think the company's dividend remains worthy of a safe dividend safety score, which is supported by a payout ratio near 50%, a healthy balance sheet backed by a BBB credit rating from S&P, and very exceptional cash flow generation that has supported rising dividends every year since 1957. These are all reasons why I decided to recently initiate a position in this dividend aristocrat with a long-term holding period in mind. The last high-yield aristocrat I'll review is Stanley Black & Decker, ticker symbol SWK. This business has been around since 1843 and is a major provider of power and hand tools, along with fasteners, lawn equipment, and various accessories, with many of its products being sold through big box retailers like Lowe's and Home Depot. Stanley's earnings were crushed coming out of the pandemic as it dealt with supply challenges and surging transportation costs, since many of its production plants were based in Asia and far from retailers. Key components like steel, plastic, batteries, and semiconductor chips also surged in price and were hard to source, which further compounded the company's challenges and led to it ordering too much inventory. While Stanley has made progress taking out costs and right-sizing its inventory levels, interest rates have jumped and stifled activity in the U.S. housing market, which drives around 30% of the company's sales. This development has slowed Stanley's earnings recovery and also kept the stock out of favor, especially with interest rates looking like they may not come down as quickly as previously thought, since the economy has proven to be pretty resilient and inflation still remains above the Fed's target. But if you zoom out, Stanley is still a very entrenched business with a portfolio of durable brands that should generate solid cash flow for many years to come. The company's long-term growth is also supported by its increasing presence in emerging markets and its opportunities to make more electrified products. Shares yield nearly 4% today, and you'd have to go all the way back to the financial crisis to find a time when Stanley's yield was higher than it is now. While this is a business that will be closely tied to the economy and the outlook for interest rates, I can see how it might interest patient investors who are looking for income and value. I hope this video gave you some interesting dividend growth ideas for your portfolio. If you enjoyed it and want to get our future videos analyzing dividend stocks and income investing topics, please hit that like button and subscribe. If you have your own dividend portfolio, you might also want to check out our website, simplysafedividends.com, which offers a powerful portfolio tracker, dividend safety scores to help you avoid cuts, valuation charts to help with buy and sell decisions, dividend stock research, and a whole lot more. Thanks for watching, and I hope to catch you next time.